Today, I'd like to talk to you about the way we pay off our mortgage. There are three methods to pay off a mortgage, and I'm sure you're aware of the first two, but we've got great news because we have a brand new system called the Mortgage Cancelator method that we're going to reveal to you by the end of this video. The first way we pay off a mortgage, everyone knows how to do that. It's make 360 regular payments, and that is good for the bank. Now, if you refinance, you can turn that 360 months into a lot more, and people do that all the time. The second way is to make some additional payments. Now that's better for you. And then the mortgage cancelator method, that's great for you. Method one, make payments for 30 years. Now I understand if you're not thrilled about that, but that's kind of the plan that most people are on. You make 360 regular monthly mortgage payments. So let's take a guy starting age 42, $325,000 mortgage, 4.75% interest rate, and his payments are $1,695 a month. By the time he pays off his mortgage, at the age, by the way, of 72, he will have expended $610,326 for a $325,000 house. So you have $325,000 of principal. You will have paid $285,327 for a total expenditure of $610,326. Now that $285,327, that is 87.8% of what your house cost. So it almost doubles what you expend for your house. The red side here is the interest paid. You can see it's almost equal to what you would pay for your house at 4.75% interest. The interest rate is 4.75%. The interest volume is 68.7% on average for the first 10 years. In 10 years, you'll have paid $140,790 in interest while reducing your mortgage by a mere $62,652. Of your first $1,695 payment, $1,286 of that goes to the mortgage company. That's a whopping 75.9% of your payment. You can see why this is a great deal for the banks and mortgage companies, not so much for you. Your house will also need to appreciate at an annual rate of 2.31% in order for you to just break even having to pay all that interest. It's a system designed to keep you enslaved to debt essentially forever. And the average homeowner either refinances every 5 to 7 years or moves to a new house, restarting the clock. All right, now that we've covered the first method, let's cover the second method. This is a little bit better for you. This is where you make some extra payments, and they can be on a regular basis, they can be once in a while. Whatever you do, this can help decrease the amount of interest that you pay. The method I'm going to show you here is where they do once a year. They apply, in this case, we're going to cover 1, 2, and 3 extra monthly payments. So we start with one extra monthly payment of $1,695 per year. This will reduce your interest paid to just $237,239. It will pay off your mortgage in 25.6 years instead of 30. This saves you 53 months of payments totaling $89,835 for your $42,375 in additional payments. That's a pretty good return. The chart to the right, you'll see as we go through payments 2 and 3, how the red, green, and yellow start changing. This is 2 extra monthly payments, which is $33.90 per year. You're going to apply once a year to your mortgage. That's going to reduce your interest paid to just $204,094. The mortgage will get paid off in 22.4 years, saving you 91 months of payments totaling $154,245. You achieve that by applying $74,580 in additional payments over that 22-year period. Here's 3 extra monthly payments, a total of $5,085 once a year applied to your mortgage will reduce your interest paid to just $179,698. Your mortgage will be paid off in 20 years even, saving you 120 months, 10 years, of payments totaling $203,400 for your $101,700 additional payments. That's a great return. However, there's a downside to it. The money you use to accelerate paying down your mortgage stops working for you, and it can no longer grow using compounding interest. Albert Einstein said, compounding interest should be the eighth wonder of the world. This is the guy who did all this stuff in physics, and he comes up with this idea that compounding interest should be the eighth wonder of the world. He also made a statement, poor people pay interest while rich people collect interest. Okay, now the exciting part. This is method 3. This is a brand new system called the Mortgage Cancelator method. The Mortgage Cancelator system gives you the best of both worlds, paying your mortgage off early, saving interest, and letting the money you use to pay down your mortgage continue to grow at a 4% compounding rate. You're probably wondering, how is that even possible? Well, the wealthiest people on this planet have been using this system to amass huge amounts of tax-free wealth, and now you are about to learn how as well. There's a financial instrument that gives you this power and ability to take control of your financial future just like the wealthy do. You've even heard of it and may even have one, but no one has shown you it has this kind of power and benefit until now. Regardless of which method you use to pay off your mortgage, each one requires that you carry mortgage insurance. Now, this policy is designed to protect the banks and mortgage companies, not you. You can waste your money on a mortgage insurance policy that will expire worthless unless you die, heaven forbid, or you can leverage extra payments to pay down your mortgage by purchasing a specially designed permanent life insurance contract along with a myriad of its long-term benefits. So let's pull back the curtain and let you in on just how this works. For our example, we'll use the same $325,000 mortgage at 4.75% interest with monthly payments of $1,695. Let's take the 3 extra payments used in method 2, and instead of putting that $5,085 each year towards the mortgage, you'll use it to pay the premiums of this specially designed permanent life insurance contract. When you make your premium payment for year 5, you'll immediately have access to $13,592 in your cash values from your policy, which you can now leverage to pay down your mortgage. By year 5, your mortgage will only have been reduced to $297,370, but you will now accelerate its pay down by $13,431 in one fell swoop, saving you thousands in interest. By year 10, you've accumulated money in your cash values again to the tune of $23,284, which you'll ask the insurance company for, and they will gladly give it to you because they are under contract and you have the first right to use that money. Your mortgage gets reduced by another $22,015. Year 15 reduces it by $19,193. Year 20 reduces it by another $15,386, paying your mortgage off in just 282 months or 23 years and 6 months. That's great for you. But there's even more to this. Even though you've pulled $66,379 from your policy to accelerate paying off your mortgage, that money is still growing at a compounding rate of about 4% annually. Another thing to note here is that each year the insurance company gives you a tax-free dividend, which is contributing to your cash values. So the insurance company is actually helping you pay your mortgage off as well. At this stage, you are out from under the weight of a mortgage about 6.5 years ahead of schedule. So now it's advisable to pay yourself that last 6.5 years and put that money back into your policy. Unlike standard mortgage insurance that expires worthless, this is your result at age 70. Your mortgage will be gone in 23.5 years. You'll have saved $130,542. You'll have a death benefit that continues on and grows 188,000 plus. Your outlay was $108,997. And then you have cash already built back up of $94,000. Then you have these accelerated death benefits, chronic illness, terminal illness, and specified medical. Or you could do method one, and your mortgage will be paid off in 30 years. Total interest saved? Nada. Death benefit? Nothing. Term policy outlay? Probably in excess of $11,312. And the cash room policy? Again, zip. That's why this has so much power. Look at your benefits. Look at what you could do if you had to wait and try to pay off your mortgage in 30 years using method one. And though you spent about $8,000 more using the Mortgage Cancelator system, you can see the incredible difference in your return. Several $100,000 in benefits. Benefits that had you paid separately for would have cost you an additional $120,000. See why we say great for you. Here's a chart. When you run yours with your agent, it'll give you the exact chart for your payoff. In this case, you can see the red and the green line. The red is the plan of 30 years. The green is the cancelator method, where in year 6, we apply some, and then it starts widening the gap between these two. Then in year 11, another amount is paid, and then it starts accelerating. 15, same thing, 20, and then finally by age 65, your mortgage is gone, not 72 like the 30-year plan. While everyone's situation is a bit different, the principle is based on math, and numbers don't lie. So fill out the Mortgage Cancelator form with your basic information, and your agent will get with you to see exactly what this can do for you. Here's the form. If you're watching this video because it popped up when you were sent to this form, you can close that at any time. You can fill out this form, click yes, send me my report. It'll send you a link to a report. It'll give your agent the information they need, and then they will get back to you and run the Mortgage Cancelator so you can see exactly what it will do for your situation. By the way, this won't work with just any insurance company either. That's why we've selected one of the best in the industry, which has paid dividends even during the Great Depression and the most recent Great Recession. It was established in 1905, and while there's insurance companies that are older, look at the ratings this company has. AM Best A+ superior rating, Standard & Poor's AA rating, 95 Comdex rating, Fitch's AA rating. This is a mutual company, and that's part of the magic of what makes this work. A mutual company is not like a stock-owned company. The mutual company is owned mutually by everyone who owns policies, and so the dividends come back in, and that gets distributed to everyone who has a policy. And don't worry about the extra payments needed for the premiums. Our agents are trained to help you find the money in your existing budget, and you'll be surprised at how much you really have to make this work. So don't hesitate. Give them a call or fill out the Mortgage Cancelator form right now. This is a no-obligation consultation, and at the very least, we'll make sure you get the mortgage insurance that is needed, but structured so that if in the future you want to apply the Mortgage Cancelator method, you'll be able to. All insurance policies will not necessarily let you move into the Mortgage Cancelator method. I want to thank you for your time. We hope this has been enlightening and helpful, and we look forward to serving you.